So, welcome everyone. I just want to say thank you to everyone who took this time this evening to spend it with us here at Pheenyx Capital. I'm very grateful. And we're going to dive into this amazing investment opportunity, but I want to share something with you that has been on my mind lately. And if you guys are okay, I want to do a little bit of a history lesson. It'll take maybe 15 to 20 minutes, but I promise you we will jump into the deal. And I will help you guide. I'll give you a history lesson, then I'll guide you back to 2025. So I want to start with this, and I just want this in your mind percolating as we go through. I want you to think through history, right? There were moments when the economic tides shifted. There were these brief windows where asset transfer went from really weak hands to strong ones. And these weren't just very small opportunities, right? These were wealth migration events that created this generational fortune, but they were for really small windows. And so today, before we talk about the rise, which I think is a wonderful opportunity, I want to show you why we're standing in exactly such a moment, that brief window, that small opportunity where we have the potential to create generational fortunes. Like I said, and I said it before, please ask questions. So if you're using your laptop, you get a better experience. But if you're on your phone, that's fine. But still go ahead and just ask any questions as we go through this deal. Before I dive in, I want to take a moment to just address something. Let's just get it out of the table, something off the table, something really important. As accomplished professionals, all of you in this room, right? You understand the value of thorough due diligence in anything that you do. So the information that I'm sharing with you today is exactly that. It's for you. And as I'm excited to share this opportunity, I encourage you to review everything that I've said with some of your trusted advisors, because that's what we sophisticated investors do. We do our research, we do our due diligence, and then we invest. So now let's get into what really matters and really why we're here today. I told you that I would tell you a little bit of a history lesson. And it is this. Mark Twain said something really important. He said, history does not repeat itself, but it often rhymes. And about that, right? History does not repeat itself, but it often rhymes. The wealthy, the uber wealthy, they understand that they understand what most investors miss. Is that market cycles, they follow somewhat of a predictable pattern, right? I'll tell you this. Here comes my history lesson. In the 1930s, right, Joseph Kennedy, he built his dynasty buying Depression era assets on pennies. He bought it like at pennies for the dollar. And then it happened again in 2009, right? Firms like Blackstone, they acquired 12.5 billion of like distressed properties, while others feared that real estate was dead. They were just acquiring and see where they are today, right? What is it that they saw that others missed? What is it that we missed at that time? It's that they recognized patterns and they really knew how to read the tides. And so I want you to know this, that every single market cycle, it involves a wealth transfer phase. And that's what you're seeing on the screen. But most investors, you and I, but not after today, right? We focus on the obvious parts of the cycle. We focus on the peaks and on the valleys. But real fortune is made in the transition points, right? It's specifically the moments where assets begin to transfer from distressed owners. And distressed owners might not necessarily mean that they're managing the property badly. It just might mean that they're unable to pay debt, they are unable to refinance, and that's what makes the property distressed. So there is this moment where assets were transferring from distressed owners to strategic buyers. And that's where the wealth transfer phase happened. And that's almost exactly where we stand today. So think the 1930s and think 2008. But what makes this different, right? We are in this, and stay with me because this is getting good. We're in this unprecedented convergence of three economic waves, and we millennials make up one of it. But it's something that I call the perfect storm, and it's the perfect storm for like strategic asset acquisition. It's this idea of like distressed opportunity tsunami. So a lot of distressed assets coming to the market, right? And then institutional capital flooding. So something we call dry powder. And then this demographic demand driver. And that's kind of where millennials come in, and even baby boomers. So those three almost kind of economic waves have created this perfect storm. And I want to go into it in a little bit of a detail. So the first wave, right? The first wave is already hitting the shore, if you want to think about it like that, right? But it is that over 1 trillion in commercial real estate loans are maturing between like 2024 and the end of 2025, and maybe even into 2026, right? And many of these loans they were originated when interest rates were like at a historic low. So think about like the COVID era, where interest rates for some commercial loans were like 1%, 1.5%. And then now where it is today, where it's closer to 4.5, right? Today's refinancing environment, it has caused almost this like gap, right? Where you had interest rates, a lot of owners bought interest rate, but they didn't buy fixed debt. And so interest rates have been increasing. And now they try to refinance and they cannot afford their mortgage. They can't afford their debt. So what's the result of this, right? You have this tsunami of really distressed assets that are hitting the market right now. And it's not because the properties are failing. The properties are doing well. It's just that like the foundation, which is the financial structure, it just isn't supporting it anymore. So we have that, the tsunami that's hitting. And then the second wave is this like wall of institutional money that is preparing to deploy. And I want you guys to hear me, right? Private equity real estate fundraising went almost doubled from Q1 of 2024 to Q1 of 2025. In that period, the fundraising for private equity funds to buy real estate went from 32.5 billion to 57.1 billion. That is almost a double in a year period of like dry powder, what we call dry powder, which is money that's sitting on the sidelines, ready to pounce on these distressed assets. So think the likes of like Blackstone, of Brookfield, and other major players where they've raised massive, what we call opportunistic funds, and they're specifically targeting distressed real estate. It almost feels like 2008, right? And also in the 1930s. And I want to tell you something. This is not just speculation. It's already announced. If you Google, if you look online, you'll see it. It's committed capital that is getting ready to hunt for bargain. That is something that we're seeing right now. And so then this is the third part, right? This is a third wave. And it's this sustained demand for quality rental housing. So housing is a basic human need, right? And everybody needs a place to stay. Now, the previous generations, right, they built wealth through home ownership, right? Between ages of like 19 to 27, right? The thing to do is to buy a house. But today, with the rising interest rates and housing affordability crisis that is happening, right, it has pushed homeownership out of the reach for millions. Also, like a lot of Gen Zers, millennials are opting to not buy and they want to rent. And a lot of baby boomers are finding that they don't want to live in big homes. They just want to rent, right? So you have this shift that is like almost forced towards rental and not buying. And it's not a temporary choice, right? It really feels like a long-term reality where a portion of the population is they're just deciding, I really don't want to buy anymore. I'd rather just rent. And if you think about like work from home or work from anywhere, right? You could travel the world, you can rent, and you don't have to buy, you don't have to be stuck in one place. This is not a temporary blip, right? Just like something that's going to come and go. It feels generational, and it's really restructuring how Americans are really accessing housing, which is very important. So this is the part, right? We hit this convergence point, right? And it's these three waves, they come together. Remember I told you it was distressed assets, and then available capital, and then sustained demand, because we all need a place to live. And they create this almost like extraordinary opportunity, if you want to call it. And this hasn't happened since like 2008, 2009. But like 2009, right? A lot of the investors, they'll miss it because they'll be focused on the headlines instead of the underlying pattern, which is why I'm telling you that, remember, history doesn't repeat itself, but it rhymes. And so we want to be educated investors. We want to know what exactly is going on in the market. We are not trying to time the market, but we're realizing that time in the market is going to be able to teach us some of these things that we need to learn. Now, this is the touchy-feely part, but then you ask the question, right? Why do a lot of investors miss this defining moment, right? And it lies in human psychology. one of my favorite all-time investors, Warren Buffett. He said, be fearful when others are greedy and be greedy when others are fearful. And we know this, right? We know this very well. But if you look at study after study after study, it shows that investors actually do the opposite, right? They buy when there's like peak excitement. Like if my mom calls me and tells me it's time to buy something, it's probably time for me to sell it. And then they sell when there's like blood in the water, when it's like maximum fear, when everyone is getting rid of whatever it is, right? That's when people start selling. But you probably want to do the opposite. Now, where we are today, 2025 Q2, it feels like there's a little bit of fear in the market, right? You're hearing the headlines of the housing crisis, and that's really dominating the news. But if you understand the cycle and you recognize the precise moment to position yourself, that's what we need to do right now. And we're positioning ourselves for the next decade of growth, but we have to be ready to go right now. And if you asked me the best time to invest, I would have told you, I wish I invested in real estate 10 years ago. But the next best time is today, right? And that's because we are making sure that we have time in the market, which is going to position us for the next decade of growth. So the window, this is that window that we're operating in right now, right? And it's going to last for about like 24 months. And this is just based on my research, right? Because we know that interest rates have peaked, and we know that distress is evident, and we know that institutional capital, they've raised all the money, they haven't deployed all of it. By 2026, right? 2026, maybe even a little bit into 2027, we're going to see that these bargains that we're seeing today, they would have been absorbed by the major players, the big institutional funds. So the opportunity to acquire really solid institutional grade assets at substantial discounts, that period would have closed. And so we want to position ourselves today for exactly what we're expecting to happen tomorrow. Now, I'm getting to the deal, I promise you. I told you 20 minutes, but what do big institutional players know that gives them a ton of confidence to deploy billions right now? Like, what do they know that we don't know? And there's these four fundamental truths that I think that we have to keep in our mind. And it's that a lot of times, like, real estate is ultimately tied to replacement costs. So what does that mean? It means that in today's acquisition prices, like what we're buying today, they're about, honestly, like 20 to 30% below what it would cost us if we built today from scratch. And so you notice that more people are buying, they're acquiring as opposed to building. But also another thing that is very clear is that population growth, it drives housing demand. So as the US continues to grow, right, with a lot of the growth happening in the Southeast, because you know that people are moving out from West, they're moving South, from North, they're moving South. A lot of your Silicon Valleys, they don't have to be out West anymore because they can work from home. And so they're choosing where population is growing, where rent is growing, where it's cost of living is cheaper, and they're moving to the South. And that's why at Pheenyx, most of our investments, really, we focus heavily in the Southeast region, and it's for that reason. And then thirdly, right, you see this, that inflation, it just erodes debt. And that's one of the biggest things. But then you see the opposite happens in real estate, right? Inflation actually benefits leverage real estate investors. And that's exactly who we are. And then this is the last thing. I said that before, I was hinting at this, which is that quality assets, they will grow. If they're in growth markets, they will always recover. So remember that cycle I told you about, right? The question isn't if, it's when. So it's not about, again, it's not about timing the market, it's about time in the market. So it will always recover, and the question is just when. So this is the last part before I get into the deal. I know you guys are excited and some of you are already ready, but this is where it kind of gets interesting, right? One of the things that is to our benefit is that institutional investors, they have capital advantages. They have money sitting on the sidelines, they're ready to deploy. I told you they have dry powder, but they have some significant advantages when it's some disadvantages compared to our community. And that picture, which you'll see, I think you'll see it again later, but that is us and a bunch of investors who went to the property 2 weeks ago and who did due diligence. So we brought some of our investors who knew that they were going to get into the deal and they wanted to come and check out the property. So we gave them access while we did due diligence. But these institutions, they move slowly, right? They have investment committees, they have lengthy approval processes, they have all this rigid acquisition criteria. But our community, we move with a little bit more agility. Like I said, which I just told you about the picture, right? We do significant due diligence, but we recognize that value does not necessarily fit neatly into an institutional spreadsheet. We have our own spreadsheets, but we realize that sometimes value doesn't fit neatly into it. So we can close quickly when sellers need a lot of certainty. And so this gives us access to a lot of opportunities that institutions miss, either because, also the deals are too small for their mandates, or because they just can't move quickly enough. So that puts us at an advantage. And then this is the thing that I kind of love the most, is that many of you on this call, and I'm excited, is that you've built successful careers in medicine, in tech, in law, and in other professions, right? And these careers, they just don't provide income, but they really provide credibility, the relationships, the expertise that we can leverage in real estate, right? It's using your 9-to-5 as your foundation in order to build all the things that you want to build in order to grow wealth. So this is another advantage that our community holds. It's this ability to understand and to really access real estate while maintaining, the security of our professional careers. So we stand at a fork in the road, and there are two possible paths for you to take to move forward, right? The first path is to remain a spectator, to just sit on the sidelines and to watch. And you're watching as assets transfer, as opportunities pass, and as others position themselves for this next upcoming decade, right? That's one path. But then also, you can become a participant, and you can recognize the patterns, you can understand the timing that we talked about, and we can position ourselves strategically while this window remains open. And it's one that we should really take advantage of. So this brings us to our specific opportunity that we're talking about today. And let me just say this, I am excited. I'm honored to be able to bring this opportunity to you. And I want to present the Rise to you. And it's exactly that type of strategic opportunity that we just discussed, right? It's a high quality asset in a growth market, and it can be acquired at exceptional value due to market conditions, which I've kind of told you all about that, right? It's a 128 units Class A property, and it was built in 2022. So this is our newest acquisition. And really, it embodies that value of the value investing that we see in real estate. And I want to show you why, right? Now, before I continue, I just want to tell you that this deal is only open to accredited investors. If you're here and you're not an accredited investor, I still want you to reach out, and we can understand your goals and see how kind of this will align, maybe not on this deal, but how we can align together and get you ready for the next one. So the more people who reach out to us and kind of tell us, then we can get a list going for our other opportunities and maybe the next one. So after you're hearing that, as we jump into the deal, there's some people who are ready to act. And if that history lesson was all that you needed to jump in, and for those of you who maybe might not be able to stay till the end, right? Our team is going to put up a link right now. And all you have to do is click on the I'm ready. And all you need to do is just toss in a few information. And one of our team members will contact you in the next 24 to 48 hours. And so that we can talk to you, understand where you are, and get you into the deal. So on that note, I want to share a quick video. It's a 2-minute video, and it was me and the whole team, our internal team, our external team in Atlanta 2 weeks ago while we did due diligence. So I'm going to play this video. We are at Conyers, Georgia. We are at the Rise, and we are acquiring this amazing asset for our investor community. Today, we are doing due diligence, and the entire team is here. So we are looking at every single property. We want to make sure that what we assumed on paper is actually what we see in real life. But we're also doing financial audits. We're looking at the rent receipts. We're looking at everything on paper as we compare what we're about to purchase. So we have been here since 10 a.m. in the morning, and honestly, the feedback has been amazing. What we have reviewed has been really good. As much as this is important to us at Pheenyx Capital, we have to make sure that our investors know exactly what they're getting, what we're purchasing. So I've had the opportunity to go into some of the units and actually walk the units. And this is a pretty new property. It was built in 2022. I can already tell that our maintenance cost is going to be low. So if you guys don't know, this is probably really exciting. 20th Century Fox and Warner Brothers, they are actually expanding their studio to Conyers, Georgia. Because one of the things that we look for is the people who are coming into the area. So the types of jobs that are growing in the area and the types of opportunities that are coming. So the fact that these people are here is very exciting because it is building the Conyers, Georgia population. And those are the types of things that are very important to us as we think about location and when we do market analysis. What's even better is proximity to Atlanta. So it's less than 30 minutes away. So people can actually live here and work downtown, and the commute is barely anything. For me, this has been such an exciting opportunity, and everything that I have seen has reinforced exactly what we're doing at Pheenyx Capital. I am truly excited to bring this opportunity to our investors because this is just yet another way that we can grow wealth through passive income in real estate. Okay, so like I said, that was me 2 weeks ago with our entire team, including our property management team, and we scrubbed the property. So we looked at plumbing, we looked at HVAC, we looked at landscaping, we assessed every single apartment unit, and we reviewed our renovation budget based on what we saw, and we made some changes based on the feedback from our external team, all the people that I just mentioned, and our property management team. So that is exactly what the due diligence process looked like. And it was, we did it 48 hours. We were there morning till evening on both days. So our acquisition thesis, it centers around 5 key factors. And I want to share this with you because it's really important. First, I talked about this a little bit ago, but we are acquiring the asset approximately 22% below what it would cost if we built it today. Secondly, the property is located really at like a high growth MSA, Atlanta MSA corridor. So it's less than, like I said in the video, and I drove it, it's less than 30 minutes to downtown Atlanta. So they get the benefits of being on the outside, but being able to commute very easily to Atlanta. And then we really purchased it with favorable terms, even in today's market. And what that does is because of how favorable our terms were, it creates immediate equity from day one. Now, one of the features that I'm really excited about is really the strong employment and population growth that is driving rental demand. So because of all the industries that are in the area and that are moving into the area, and I'm going to talk about that a little bit later, it's really driving rental demand. And so people want to live there. And then the final thing, one of our 5 key factors is our exit strategy. And it's supported by multiple institutional buyers. They are acquiring assets that are similar to what we're acquiring in the market. So at the right time, it positions us to be able to sell these assets with some ease. So from here now, we'll just talk about the property. And like I said, if you have questions, toss it in the chat. But this is the property. This is the property summary. So we're purchasing it for $25.3 million, and we are actually purchasing it $700,000 less than asking price, and we're using a fixed debt at 5.05%. And some of these things, as I go through the slides, you will get access to, 1, you'll get access to the recording, but 2, you'll also get access to the presentation deck. So the full entire investment deck, which has all the information. So for this deal, we are offering 2 investment options, and it's Class A and Class B. And I want to spend a little bit of time and explain both of them so that you kind of understand where you stand, right? So Class A, it provides more secure return. So you get 10% preferred return, and that is with prioritized cash flow. What does that mean, right? It means that in the capital stack, right? As soon as rent comes in, expenses go out, right? The first people that we pay is our broker, is our lender. So we pay our lender first, and the next set of people that get paid are our Class A investors. So they are only getting 10%, but they're getting that 10% preferred return. And this is kind of ideal for that investor who is seeking, very predictable return with very low risk. So they're like, I really don't care about profit sharing at the end. I really just want cash flow in the beginning. So remember the capital stack, lenders get paid first, and then Class A, then Class B, then us as the operators. So we get paid last, but Class A gets paid first after we pay debt. Now, Class B is you get a little bit of both, right? So the Class B investor is someone who is an investor who's comfortable with risk, with a little bit of risk. So you want more equity-like risk return profile. What does that mean? So you are going to get 6% preferred return. So that's on a yearly basis, right? You're going to get 6%. And then at the end of the deal, you're going to participate in the profit share. And that profit share is 80-20 split. So 80% goes to you as the investor based on your investment, and then 20% will come to us as the general partners and the operators. So between your 6% preferred return and your 80% profit split, right? If you combine those together, it looks like you are making 16.1% every year on your investment. So when you see that number that we say anywhere from 15 to 18, for this property, it looks like 16.1% based on our underwriting, based on our assumptions. And now that we've gone to look at the property, I feel more comfortable with that number. So that's what it looks like, Class A, Class B. Now, you might be thinking, well, okay, I get it a little bit, but what does this look like? Like, break this down for me. So I created just a good, like a sample $100,000 investment for Class A and for Class B. So you can see what that looks like. For Class A, I told you, $100,000 investment is, remember I said 10% preferred return. So that's year 1, year 2, year 3, year 4, year 5, you're getting 10%. That doesn't change. And then at year 5, you're going to get return of your capital. And then, and that's kind of it. So you got 10, 10, 10, 10, 10, which is 50. I think I did 5 10s plus your $100,000. So that looks like at the end of the deal, you would have made 150,000. So that looks like 1.5 times what you put in the beginning. It's that easy. So it's steady, predictable cash flow throughout the entire hold of the deal. Now, Class B is a little bit different, right? So remember, you're getting that 6% pref, and you're getting that year 1, year 2, year 3, year 4, year 5, and that looks a little different. And then year 5, you'll see on the 4th line, I think you'll see that profit share, which looks like 54,000, right? So if you add up all your investments, all your distributions every year, so your preferred return plus your profit share, if you total that plus the return of your capital, so your $100,000 that you got returned, right? If you calculated that, you would have made $180,000, $180,645. So that looks like 1.8 times what you put in, right? And that, when you break it down, is 16.1% average annual return, which just means what you're making on a yearly basis when you look back. So the difference now, if you looked at it kind of apples to apples, right? If you invested as a Class A investor, you would walk away with about $150,000 at the end of the hold period, which is 5 years. And if you're a Class B investor, it would look like about 180,000. So if you're thinking like, which one, where do I fall into? Just think about your risk appetite, right? Think about and also when you think about your risk appetite, also think about how much cash flow do you need today? So if you need significant cash flow today, then maybe your best bet would be to invest in Class A and then just get your steady returns. But if you're interested if you're interested in profit share and to make more on the back end, then Class B would be where you'd want to go. So this is just uses of capital, right? But I want you to see this because it helps to ensure that you know that we have the capital necessary, 1, to implement our business plan, and 2, to be able to maintain like operational flexibility. So all the things that we need to do to make sure that the properties run as smooth as possible. And then I talked to you about debt. And this is kind of just a breakdown of what that looks like, but we secured 5.05%, which is actually lower than current market values, current market rates today. And also our LTV, so loan to value, right? We're borrowing 60%. And that's a conservative leverage because it still allows us to maintain cash flow and returns because we're bringing a significant amount of equity into the deal. So that's what that looks like. If we're over leveraged, it looks like, like 90% we're borrowing and we're only bringing in 10%, but that's not the case here. So now I've talked to you about kind of like direct returns. And I know that there are a lot of high net worth investors here who are thinking, what else, how else can investing in multifamily apartment real estate benefit me, right? So these investments, they offer significant tax benefits, and that's through depreciation. So $100,000 investment, right? It will typically generate about $23,000 in tax savings in 2025, but that's over the hold period, so the entire 5 years. But what it does is it really just helps boost your after-tax returns. So this, this tax efficiency, which another easy way to just say is depreciation. So when someone asks you, it's really one of the key advantages to multifamily investments when you compare it to like other asset classes, because you are able to offset your passive losses with all the tax saving benefits that you get when you invest in apartment real estate. So that's just basically one of the ways to offset some of your, one of the ways to get significant tax advantages is to invest in real estate and to invest in specifically apartment complexes. Okay, so this is like the fun part, right? This is what the area is and kind of what's in the area that we're buying. And I want to kind of allow you to see this, because when we look at where we're buying, right, we have to strike a balance between affordability and then also access to like a lot of employment centers. So I told you that this is less than 30 minutes from downtown, right? So imagine having access to Atlanta downtown and everything, jobs, whatever it is, nightlife, anything else, you have very close access because it's not truly that far. But then you also have all the jobs that come with that area. And then if you think about it, the airport is also close, and that airport has, I think, about 63,000 jobs. So I want to say it's the busiest airport in the country. If someone look it up or just let me know, educate me if I'm wrong, but you got to plan way ahead if you're flying through that airport. But and then like the I-75 corridor also has about like 400,000 jobs. So being in this area gives you access to a lot of jobs, and we want to make sure that when our tenants live there, they have a place to work, because that's very important. So, and another thing is, like, if you think about cost of living, right, they don't have to live in Atlanta, but they can get all the benefits of it by living 20 minutes, 25 minutes outside of it. So this is the part, like the rise, where the rise is located. It is experiencing like significant unprecedented investment growth. In the next, I think it's maybe 10 years, right? There are 4 mega developments that are coming to the area, and it's bringing $19 billion. That's really reshaping the economic landscape. So if you read in December, right, Rivian, the EV plant is coming, and they're going to be creating about 7,500 jobs. Meta is also bringing their data center, and then also Newton Technology Park is coming. And all of these investments, right, they're not speculative. They're actively undergoing construction, but they're really creating like a ton of high-paying jobs in the area. And it's really all around Conyers. And the rise is like, look at it right there. So it's benefiting from all of that. And then I just want to harp on the job a little bit more, because it's very, very important. And like, we talked about the mega projects that are coming, right? But Conyers has like really established itself as a diverse employment center, and you see it on the screen, right? But even more than, it's important that all these jobs are there, but what's important is the diversity of these industries. Now, I want to tell you this, because as you're here looking at maybe an opportunity to invest, you're probably looking elsewhere, right? You need to make sure that you're paying attention to the area that you're investing in. Because if you notice this area, right, it doesn't rely on one industry type. it has manufacturing, it has entertainment, it has logistics. And it's important to have all of that so that it is recession resistant, right? It's not reliant on just one economic driver or one industry. So like, it's not like, let's say, a mining town that, you know, like all they do is mining. And if that stops, like the entire town will collapse. That's not the case here, right? Because it has such diversity of industry, but that's something that's really important. And then I'll stop with the jobs, but this is very exciting, right? So like, Georgia is now known as like the Hollywood of the South, and it has ranked #1 in the state for, no, it has ranked #1, it has ranked as the #1 state for film and television production. So that just shows you like how big the state is growing, how big these counties are growing. And like, we as investors, we get to benefit from that. So, and a reason why I harp on this, right? Because when we think about, and I said it earlier, right? When we do market analysis on where we want to invest, location is very important, probably the #1 most important thing. But in location, what's important is job growth, it's population growth, it's rent growth, to make sure those things, those are the factors that we look at when we're really looking at where we want to live. Okay, so now this is like the fun stuff. So this is just a breakdown of the unit mix, right? When you are looking, and this is a very good unit mix, because majority of the apartments are 2 bedrooms. It's not as many 1 bedrooms, and most people prefer 2 bedrooms to 1 bedroom, but they don't necessarily need a 3rd bedroom if they don't have a family. So the breakdown is actually really in our favor. And then these are just some property pictures. I really enjoyed walking the property. And I will say this, I want to put this out there for any investor who is on the webinar, but who's listening afterwards, right? If you want a property tour, so if you're, you know, if you live in Georgia, or if you're visiting, you know, while we are actively acquiring this property, please reach out to me. If you want to go take a look at it, I'll set up a tour. And if it works out with my schedule, I will come and meet you there and we'll tour it together. But that's something that, you know, like as an investor, like this is important. So, or if you have a friend or a sibling, I don't know, family who lives in the area, send them to go take a look at it so that they get a feel, because it's one thing to see it and see how pretty it is on, you know, on the screen, but it's another thing to like go see it, feel it, you know, interact with the front desk staff, interact with the tenants, just see, kind of get a feel for what it is to live there. Because, you know, as you decide to invest, or when you decide to invest, right, you're going to be a part owner. So this is your property. So you want to go get a feel for it. So feel free to reach out to me, one of our team members. And again, we're going to put up the link so that you can just go ahead. Like if this is something that you're interested in, go ahead and put in your information and we will definitely contact you. So just really some of the fun, you know, the really nice amenities. Having all these amazing features are good because they command a premium, right? They command premium rents because everything is new, state of the art. But we want to make sure that we're still providing like exceptional value to our residents, because at the end of the day, that's what really matters. And so like, yes, the amenities are beautiful and it was great being there. But more than that, we want to make sure that like our residents are taken care of, that they're valued and that they know that. So these are just some of the like outdoor amenities. Again, you saw it in the video, you're seeing it here. When you get the deck, you'll see a lot more pretty pictures, but that is just it. So, so that's the entirety of the deal, of the investment opportunity. I want to tell you a little bit kind of about who's on the back end. So who are you seeing? Who are you interacting with? I want to share a little bit about that. So I didn't introduce myself, and I will introduce myself. My name is Nkem Ezeamama. I'm an ER physician, and I'm based out of Nashville, Tennessee. And I'm the CEO and founder of Pheenyx Capital Investment. And you might be wondering, how did I get here today? And I think for me, it all started with kind of being a little fed up with where I saw medicine going, and just away from kind of bedside care. And I felt like we as physicians, we weren't doing exactly what we were supposed to be doing, which was taking care of patients, right? And I also felt like our jobs were at stake, because I remember at some point in my hospital, we were losing hours. Some of my closest friends who became family were fired. And so I realized that no one was looking out for me. And so I was trying to figure out a way, to make sure that like I was taken care of and I did not have to rely on my 9 to 5 because it could be taken away from me at any point. And so that's when I started investing in real estate. And the funny story is that I started as a passive investor, just like you, sitting here listening on this call, and I decided to take action. I sat on the sidelines for probably longer than I should have, but then I just took the leap and I said, let me try it. If it's better than what's going on in the hospital, then I'm game, right? And it was, and I was making, I was doing well. My investments were getting significant returns. But then I thought, and I saw that there were not a lot of us who were privy to these deals, to these opportunities, right? And the people there didn't necessarily look like me. They weren't healthcare professionals. They weren't, there was less of me at the table, right? And so what I did is I said I would bring these opportunities to my community, and I would start telling as many people as I could about real estate investing and the power of diversification, and how we needed to use our 9 to 5 as the foundation to then as a springboard to then help us build wealth as we are privy and we have access to all these other alternative assets and investments that will help us grow wealth, right? And obviously, well, not obviously, you should do your research and you should do due diligence as a savvy investor. But this was the start to it. And I wanted to make sure that I brought this to our community so that if I have access, you have access to. And that's why it excites me when, like we jump on these webinars, and it excites me when, we send out distribution checks and people, like our investors are making money, because it's like, this is the beginning. This is the start. This is the path to really building wealth. But it's not just me, right? On this call as well is like my amazing team. So, our team that's made up of we underwrite the deals, we talk to our investors, we scout the we scout the market looking for the right opportunities to bring to you guys. And so our team, I can't do it without my awesome team. And so I just want to make sure that even though that you see me, that behind me are people who are genuinely lifting me up. And so you get to see that. So I just want to say thank you to them. And then of course, our investors, right? I wouldn't be here without them. We wouldn't be here without them. And so that's who makes up Pheenyx Capital. This is what we've been able to accomplish. We've been able to invest and acquire in assets totaling 95 million in assets under management. And we're growing, and we are excited that the Rise is going to be our next investment opportunity that we get to add to our portfolio. And so you've heard about Pheenyx, right? These truly are our partners. These are heavy lifts, and we don't do it alone. And so our partners, Pheenyx Capital, made up of Dr. Julius Oni, Leslie Awasam, and Tenny Tolafari, and these guys are outstanding. It is an honor to partner with them as we really, truly bring multifamily investing to our community. And they are trailblazing. They're blazing the path so that us, we can follow and we can bring our investors along. And so they have $217 million in assets under management, and they're only just growing. Chris Lento with Nkem Capital has 27 years of asset management and just experience in real estate. He is asset management extraordinaire, and he is smart. He makes sure that he dots every I, he crosses every T. And as an investor, it's an honor to know that he is managing our deals even after we acquire them, and just to know that you truly are in good hands. And then Brad with Crest City Capital is our another partner, and he is a developer in Boston and has partnered with us in a lot of our deals and just brings significant knowledge. So that's our team, and that's who you see when we are acquiring these deals. We do it together, and we're able to bring these deals to our investors. So a big part of our investment team, our external team, is our property management team. And honestly, property management is very, very crucial to our success, right? And we have partnered with Fortis Property Management Team, and they're truly an industry leader. And it's also amazing because they also invest in our deals. So they know how good, how powerful it is to be also an investor as well as being able to manage the property. So I will say this, right? A good property manager, they they are a team that focuses on both resident satisfaction, but also investor returns. So they need to make sure that the residents are taken care of and that investors are able to get their returns. That's what it looks like. So as we come to an end, I said under an hour and I did it. For those of you who are interested in in joining the Rise Ownership Group, right? You have heard and you are interested, and this is something that excites you. This might be, you might be one of our return investors who keep investing with us. Thank you. But you might also this is new to you, right? What I'm telling you is that our team is going to put a link. I think the link is going to be above. If you're on your phone, you might have a hard time clicking on it. So we'll put the link in the chat as well. But we will reach out to you in the next 24 to 48 hours. And the plan is just for us to, like I said, get to understand your investment goals and make sure that this investment aligns with where you are going. So this week, right, you will have access to our secure portal. And this portal will give you access to the full presentation deck. You also get access to the PPM, which is a fancy word for private placement memorandum. And that's just drafted by our legal team. And it's the agreement between you and I. So you'll get to read it. It's an 80-something page document, but it protects you. So it's really, I advise you to read it, to take it. And then after that, you have the opportunity to commit. You are not in the deal until you wire your funds. So don't feel pressured. This should be very exciting. It's a time to, it's a time that you get to start building and start, laying the foundation. And so after our phone call with our team member, we'll address any questions, any concerns. And then, like I said, you'll have access to the portal, you'll review all the documents, and then you'll get to make your decision. And then, like I said, the last step would just be completing the subscription agreement, which has the PPM, which I want you to review, but so that you can then secure your position in this opportunity. It's pretty simple. So some people might be asking, what is the timeline? We are planning to close a deal in the next 60 days. That's what we're looking at. And I want to emphasize that this opportunity is first come, first serve. It's on a first come, first serve basis. And if it gets filled up, we have an investment amount, an equity amount that we're going to raise. And we don't take a dime above that because we don't want it to water our investors' returns. So, and we expect this to be fully subscribed pretty quickly. So because the total equity raise is limited, and we've already had significant interest from our existing investor base because they get first access to it. So a lot of them have already voiced interest and are ready to secure their position. So after the deal is closed, and kind of walking you through a timeline, after the deal is closed, you should expect to get updates on the performance of the deal. And you will get monthly updates. So the monthly updates look like, you'll see kind of the rent roll, you'll see the T12, you see, which is a profit and loss and the financial statement. You get access to all of that because you own the deal, right? And so you will know any renovations that we're doing, any changes that we make to the team, all of that information will be made available to you. And just like really performance of the deal, that's the big thing. So how it's doing, where occupancy is, where vacancy is, all of that information is accessible to you on a monthly basis. Then you will get quarterly distributions. So the goal is that at the start of the next quarter, after we officially close, that's when you'll start getting returns. And then kind of timeline wise, when you start investing with us, you'll get access to like all our future opportunities. So that's what the timeline looks like. Another question I get is like, how can I invest, right? Cash is king. Cash is the easiest to invest with, but you don't necessarily have to invest with cash, right? Some of us have 401ks, old 401ks that are sitting because we've switched jobs a few times and we didn't roll it over. Well, that's a good thing. So if it's sitting there really not doing anything, you don't really have control over it, you don't know what's going on with it, well, you can convert it to a self-directed IRA, and then you can invest in in acquisitions just like this, in assets like this, right? You're allowed to use that and invest in it. So, and you're not going to be penalized. That's what a lot of my investors ask me, but the money's going into that vehicle and it'll go right back into it. So we've partnered with some really amazing IRA advisors. So if that's something that you're interested in, when we have the call, we will talk about it, and you'll be able to get access to it. Okay, so I'm almost done. Next steps, right? The link again should be on top of the screen. If it went away, our team will put it back up, and we'll also put it in the chat. I want you to review the material. I want you to ask questions when we meet. And then after you've reviewed everything, to go ahead and sign the documents. Those are kind of what the next steps look like. And we have come to an end. So in closing, thank you for staying with me till the end. But I started with history, right? And I want you to remember the market timing perspective that we began with and the history lesson that we learned. Great fortunes, they're made when we recognize patterns. I said it before, and we understand timing, and then we take action during that brief window of opportunity. The rise, this new investment opportunity, it's exactly that kind of moment, right? It's a chance to acquire an institutional grade quality asset that is at a discount, which I told you about, during this unique market transition. So my ask today is that you join us on this journey, and we welcome you with excitement. I want to say thank you for your time, and thank you for your attention today. So the link is above. It's also in the chat. If you have questions, this is the time. I want you to flood me with questions and ask me a ton of questions. So if you have any questions, put it in the chat. If I look at the questions, if we have, I either hope that we have a ton of questions or everyone is crystal clear and they're ready to fill out the form and invest. So here we go. But thank you so much for your time. I really appreciate it. Let us, okay. Are there any questions? How do you become an accredited investor? Oh, great question. So you are an accredited investor if you make $200,000 a year, and if you've made that in the last 2 years, or if you and your spouse combined make $300,000, that immediately qualifies you as an accredited investor. Also, if you have $1 million in net worth that does not include your primary residence, then you automatically also qualify. So you are already one, and I'm pretty sure you are one. All you have to do is we have an accreditation process that you just put in some information into an online portal and it just tells you. Or if you have an accountant, they can write me a letter. They can write us a letter so you'll be able to see it. So you have there are multiple ways to do it, and we could talk about it. So, okay. Is this per year? Alice, if you want to be specific, I don't know when you asked the question. So if you want to re-ask your question and tell me exactly what you're talking about, I will be able to answer it. I saw a question. Let me see. I can go through the questions. Is it per year? We said that one. Who are the GPs besides Pheenyx? Margaret, I answered that for you. So those were the strategic partners that we talked about. So I think I did that. I will go. So does a couple have to be married, couple, or could they just be individuals such as relatives, siblings to qualify as accredited investor? Great question. They have to be a married couple. If you and your siblings want to invest together, you can, but both of you have to be accredited investors. So, but truly, for that combination, it's a married couple. The questions are going away pretty fast. So if I want to make sure I don't miss anyone. And Margaret answered it. Yep. The next question, I'll just go ahead and read it for everyone. Akoya says the rise has already been purchased with a bank loan. What will the funds you use? What will the funds you are raising from investors be used for? Okay, so we are purchasing it from a seller, and we're purchasing it for, that's a really good question, and let me clarify that. Please let me know if this makes sense. So it's costing us 25.3 million, right? We are getting a loan from the bank and we are raising 8 million. So the combination of those two, so the bank has given us 60%, and the rest of the 40% of the total 25.3 million is coming from our equity. So we're raising that, and that's where investors are investing with. I hope that makes sense. So it's not, the bank isn't giving us the whole thing. They're only giving us 60%. Okay. What is the idea? George asked, what is the idea behind the 5-year exit? What if the market is FIWN in 5 years? Okay, so this is a really good question, right? So our business plan is a 5-year business plan. So by the time we go in and we do renovations and we manage the property better, we want to hold it for a period of time that is long enough so that we make good returns for investors, but we don't want to hold it. We don't want to hold it for 10 years, or we don't want to hold it forever. That is not our business plan. So George, if you, what you have to understand is that you are right? If the market is not where it needs to be, maybe in 5 years, we have the option to do a cash out refinance and be able to give you or your investors money back. But we do something, right? By year 3, year 4, we do something called the broker opinion of value. So our broker will tell us, okay, this is where the market is. This is what we think that we can sell this property for. So based on, we have our underwriting, and you have access to see that. So if you want to see like our full underwriting, our assumptions, our timeline, you can see that. But they will tell us, okay, the market is really good. This is what we think this property can go for. If we have met our business plan where we want to be in 5 years, we will absolutely sell. So I hope that helps to answer your question. Okay, great. I just saw that question. That's a really good question. So yes, so Ngozi, the property is a 2022 property. So we have a business plan, right, to go in and do kind of, after we did due diligence, right, we saw some things that we need to fix. So we added that in our kind of our renovation budget. But because it's a new property, right, we have more of a, we want to go in and do more of a tech package. So we want to upgrade where it was from 2022 to 2025. So we will not be doing significant renovations. This is not a property. This truly is a Class A property. So it's not a property that we're going to go and like demolish and gut and really do significant renovations, because it doesn't need it. But we are strategic about exactly what we're going to be doing to each property, because we still have rooms to increase rent. And so part of our business plan is going in and doing those things and being able to capture some of that for our investors. I think we have some more questions. We answered this already. Are there any other questions? I think I saw one more. I heard, I got Doc, the figures here are different as projections for Class B shows 100,000 invest and 100,000 somewhere. So I think you might be thinking about another property, right? So every single property that we underwrite and we assume is different because all the numbers are different, the location is different, so the returns are different. So if you have seen, this is our first presentation, this is our first reveal of the rise. So this is the first time that I'm showing you these numbers. So you might be looking at a different property that we've talked about in the past, and the returns are different. And also because that was also an older property, so renovation plan was different, investor returns were different. It all just differs from property to property. So that was a question that was asked. I'm gonna still hang out a bit because some people are still typing. And then like, if there are any questions on any other platforms that we're streaming from that I can answer, toss it. Yes. Koye asked, are the other partners also raising funds? That is correct, yes. So everyone is bringing capital into the deal. Our total raise is 8 million and change. And this will have, you'll have full access to, like I said, the entire presentation deck. It will have the breakdown of everything, so you'll be able to see that. And also, you'll have access to this recording, so we'll have all the information. I still see someone typing, so we'll keep hanging out. Okay, so Koye asked a question. He said, is it possible to invest with Pheenyx as well as other partners? You absolutely can. You can invest. We're all, so let me kind of explain, right? It's all one pool, and all of us partners bring in our investors. So you absolutely can, thank you for putting that on the screen. You absolutely can invest with multiple partners if you want. That is completely allowed, but it's the same, it's all in the same pool. So you can't go wrong. I will say this, you cannot go wrong with any of our partners. They are all fantastic, 10 out of 10. Just know that like it's one property, it's one deal. So wherever it goes, it's all coming into one pot. But these are great questions. So please keep the questions coming. I want to be as transparent so that everybody gets a better understanding. Okay. Shem said, what is the minimum and maximum investment and projected return? Okay, this is question. The minimum investment for a Class A and a Class B investor. Class A investment, the minimum investment is 100,000. Class B, the minimum investment is 50,000. For Class B, the maximum investment that we will take for a single investor is about 1.3 million. So you're going to range anywhere from 50 to 1.3 million. And for Class A, the minimum investment is 100,000. Return on investment, you're looking at, for a Class B investment, you're looking at 16.1% average annual return. So over the life of the deal, I put up a slide that shows like 100,000 sample investment. That looks like about 180,000 in 5 years. Okay, so that I respect everyone's time. If I don't see anyone else typing, I want to go ahead and say thank you. Thank you for your time. The questions were great. If you need any more clarity, please go ahead. And like I said, let's put the form one more time. Let's put the link one more time on the screen so that if anyone wants to go ahead and just put in their information, log in, put in their information, we'll be able to get a hold of them. So if you could put it on the screen one more time. Perfect. It's in the chat and perfect. It's on the screen. So I want to say thank you so much for your time. And it was really great seeing everyone here. And I look forward to meeting you guys as we start setting up those calls and getting to know a little bit more of where you are and how we can partner together on this investment opportunity. Have a wonderful evening. Well, everyone have a wonderful evening.